Hello. When most practitioners think about tax authority, they think about the Internal Revenue Code. And when most people think about the U.S. law, they think about the U.S. Constitution. In this video, we're going to jump into legislative sources. We're going to focus on the U.S. Constitution and how powerful it really is, as well as we're going to talk about the Internal Revenue Code and why it's so important in tax. So sit back and enjoy the ride. Let's talk about the Constitution and legislative sources in terms of tax law. Now, if you ever use the phrase legislative sources in the tax area, most professionals, they're going to think you're talking about the Internal Revenue Code, the IRC. And that is by far the most important of all tax authority out there. We will be covering that in this presentation along with other legislative sources and the Constitution. So here are some learning objectives and topics we're going to cover. We're going to describe in detail the nature and structure of the statutory sources of the tax law, including the Constitution, tax treaties, not treatises, treaties, and the Internal Revenue Code. So again, we will focus on the Internal Revenue Code. We're going to delineate how statutory tax law is created and how tax research resources are generated in this process. Again, we're focusing here on legislative sources and the Constitution. We're going to demonstrate how to locate the statutory sources of the tax law. And really, in this presentation, it's going to focus on the types of legislative sources out there. We're going to discuss how the tax researcher can carefully interpret the Internal Revenue Code. This is very, very important. If you have not dealt with the Internal Revenue Code before, the structure, the citation, this presentation is going to immensely help you and help you navigate the tax law as well, especially that Internal Revenue Code. Finally, we're going to evaluate the Constitution and legislative authority. We're going to actually look at some of the constitutional legislative authorities that we talked about in the presentation and see how they stack up against one another in terms of their weight. So if you're interested in know the specific topics, again, we're talking about sources of legislative tax law. And again, the main one we're going to be focused on is that Internal Revenue Code, the IRC. We're going to talk about the history of U.S. taxation. I love to talk about history, as you know from previous presentations, so we will bring that into play here. We're going to talk about the U.S. Constitution. Can't talk about tax law without bringing up U.S. Constitution since we're talking about the United States law. Tax treaties, not treatises, treaties. So we will talk about tax treaties. The legislative process, that's a very important one. If you're not sure how laws are enacted, specifically tax laws, we're going to cover that. And finally, we're going to be spending a lot of time specifically on the Internal Revenue Code, the structure, citation, looking at the way it's set up and ways and ideas to help navigate the Internal Revenue Code when you're doing research. We're talking about primary sources of tax law and how they largely stem from statutes. Now, in the U.S., we have both code-based law, so the U.S. Code, and we have case law. But really, a better way to understand is that there's really three branches of government in the U.S. We have the legislative, which is what we're focusing on in this presentation. We've got the executive, also known as the administrative, so you have like the U.S. president and all of those different branches that are the executive branch with the U.S. president being appointed, like the Treasury, defense. I shouldn't say war, I should say defense, as well as the Internal Revenue Service. And then finally, you have the judicial. Those are our three branches. So the legislative, they enact code. The executive or administrative, like the Treasury and the IRS, they issue regulations. And judicial, they issue cases. So we have all three of those. Okay, we have code, we have regs, and we have cases. Now, in some countries, if you're an international person watching this, it's all a code-based system. Everything is based on the code. You might have heard of Hammurabi's code. Well, most international countries in the world are code-based. They don't have case law. They don't follow precedent. They just follow code. Now, there's interpretations of the code and whatnot, but they follow that code. So here, we're focusing in this presentation on the legislative. So the most you're going to see here is we're going to talk about the code, but we're also going to talk about things like the Constitution, treaties between the U.S. and other countries, as well as some other legislative items. So changes to the Internal Revenue Code passed by Congress and signed by the executive branch into statutory law, they go through the legislative process. So the legislative process, the code, it involves the legislator, but also involves the executive branch. So again, if you've ever taken a U.S. government class, it's not as simple, right? We've got the three branches of government, so you have to remember that. But really, Congress is the one, and we're going to learn more about this later on. Congress is the one that really enacts the code. The president signs it into power, and if the president vetoes this, and we'll talk about this later, Congress can still go above that veto. They can still go above that veto of the U.S. president. The U.S. Constitution and international tax treaties are also considered legislative tax law, and we talked about that. Some tax law stems from legislative activities that are not codified or codified. I like to say codified. And those are things like legislative history, Joint Committee on Taxation, the actual members that actually write the bill. So we'll talk more about that as well. Let's go ahead and continue on. So let's talk about the U.S. Constitution. Now, some of these things are going to seem a little bit more esoteric, not very descriptive, not very helpful, but it really, the most important thing about the Constitution is, yes, you do need to know how tax fits into the U.S. Constitution, but we're eventually going to get to the Internal Revenue Code, which is where we find almost entirely all the tax law, with interpretation coming from cases and regs and other things. The Constitution is not very helpful when it comes to tax, other than understanding who has the power to do what, states, nationalities, international issues. It's really about the power. So U.S. Constitution is the source for all federal tax law. Now, specifically, Congress can impose import taxes, but not export taxes. That's one thing laid out in the Constitution. Now, also, rights of due process and privacy of the citizen apply to tax as well as non-tax environments. So if we're talking about things like levying taxes or information, those specific amendments to the Constitution, like the 4th and 5th Amendment, right to search and seizure and right to privacy, and these things, they all apply to tax as well as non-tax items. Now, here's something we're talking about a little bit more detail. Must be applied uniformly to citizens of all states. And then we'll talk about that in a little bit more detail. We'll talk about the 16th Amendment and the constitutionality in a moment. And the constitutionality of income taxes has been upheld by the courts. You might recall the Marbury versus Madison and other cases that deal with the judicial power and whether they can interpret. And then we also have cases dealing with tax law that stem from the U.S. Constitution. Now, estate and gift taxes are excise taxes. They're not income taxes on the transfer of property, and they're deemed constitutional. Again, there's been cases that have dealt with that as well. So let's go specifically into the U.S. Constitution. Now, if you look at the U.S. Constitution, the original document, you will see that tax is referred to multiple times in multiple articles. But the most important thing is that the power to tax, to provide for common defense and general welfare, specifically the U.S. Constitution, it lays that out to Congress. It lays that out to the legislative role of the government, not the executive, not the judicial. And again, you're wondering, well, then why did you say earlier that all three branches are involved when it comes to tax law? Well, that's because the executive and the judicial branch, they're meant to interpret, just like we have Marbury versus Madison, right? In that case, it was deemed that the court system is there to interpret laws of the United States. So the executive administrative branch, like the IRS and Department of Treasury, they are also there to provide guidance and clarification along with the judicial system. So U.S. Constitution specifically lays out the power to tax to the legislator. Now, within the Constitution, there's two types of taxes broken out. And this isn't specifically stated, but you get the idea from what's being said. There's two types. There's a direct tax and there's an indirect tax. A direct tax is required to be apportioned among the states in accordance with a census. Now, this can be a tax on ownership of property as an example. Okay, throughout the states, you've got various pieces of property and whatnot. Indirect must be uniform throughout the states. It's a tax on an event or transaction. Now, here's the issue. Considering these two things historically, remember back to when the Constitution was enacted in the late 1700s, when the U.S. was becoming a nation. We've got the 13 original colonies. Now, some of those colonies, they were bigger than others. For example, Virginia was huge. Other colonies were much smaller, like Rhode Island, right? And there was also population. There was different populations in different colonies. There was more population, and you can go online, you can see what the change in population was of those states over time. They've created videos and whatnot, real helpful to see that. And here's the issue, is what if the U.S. was to raise a tax, to raise revenue, and what they did was they said, okay, 13 colonies, we're just going to make sure that you each give us $1 million, you give us $1 million each. And what they're doing is, and then the states say, okay, well, we're going to take that $1 million, we're going to evenly spread it among the people per state. Well, what if a state like Pennsylvania, which was one of the early on one of the most populated states, what if they had, just giving numbers, again, don't quote me on these numbers, I'm a lover of history, but right now, I can't remember the exact numbers, it depends on the year. But let's just say that Pennsylvania has, keep it simple, they've got 10,000 citizens. Just keep it simple, right? 10,000 citizens, 10,000 residents and citizens in Pennsylvania. And again, the $1 million has to be broken among those. And we're just going to do a head tax. However many people there are, we're going to divide that by the number of people. And then that's how the tax is going to be broken up by that state to pay the $1 million owed to the U.S. government. Okay, so we take $1 million, we divide it by 10,000, divide that numerator of 1 million by 10,000, the number of citizens and residents, right? And we're going to get $100 per person. So each person pays $100 to Pennsylvania, and then Pennsylvania pays the U.S. government. They pay them the $1 million total. Okay, so you look at that and you say, okay, all right, I understand what's going on. Now we take that same $1 million and we apply it to something like Georgia, which let's say they only have 1,000 residents. So you take $1 million, divide that by 1,000, and you're going to get $1,000 per person. And that creates issues of fairness. Okay, so you're making people in Pennsylvania pay $100 per person, and then you're making people in Georgia pay $1,000 per person. And that creates issues. So that's what this direct and indirect tax does. So let's talk about that. So a direct tax is either a capitation tax based on head count, just like we had in our example, or a tax imposed on the ownership of property, real property tax. Now in 1895, and keep in mind that date, the Supreme Court decision of Pollock versus Farms Loan and Trust Company, the court held that a tax on the income derived from the ownership of property, again, this direct tax, as a tax on the property itself, is a direct tax, and therefore it's unconstitutional, unless it's apportioned. So the original Constitution enacted in the late 1700s basically said that direct tax is only constitutional if it's properly apportioned. Getting to that issue that I mentioned earlier. Apportioned across the entire country, so you don't have this $1,000 issue versus $100 issue with the two different people, right? One in Georgia and one in Pennsylvania. That issue, apportioned properly. So maybe it wouldn't be $1 million per state, but it would be $1 million or $5 million in Pennsylvania and $100,000 in Georgia based on the number of people. Okay, that's the idea. That's apportionment. It would be making it fair, so that way maybe it would balance out to $150 a person in Georgia and Pennsylvania and whatnot, okay? Looking at the entire country. So basically, that case, 1895, they struck down this direct tax based on ownership of property, taxing on the amount of property, and because, again, the Constitution specifically says that direct tax has to be apportioned. It cannot just be unapportioned like our example with Pennsylvania and Georgia in that situation. So you might be wondering, well, 1895, wow, that's a really long time when you think of when the Constitution was acted in the late 1780s. And you're right. And the reason is because the U.S. government did not rely on taxes until very much later on. Specifically, the first time the U.S. government actually enacted an income tax was in the Civil War. So you're asking, well, how did they raise revenue? And you can find this out, again, doing some research, looking at U.S. history. It was mostly through import and export tariffs. You might remember this was one of the issues why the Civil War happened in the 1800s, U.S. Civil War. If you think about it, right, you've got the North states and the South states. The South states, they were exporting their goods like cotton, tobacco to places abroad like England and Europe. And they have the Industrial Revolution over there, and they're processing the cotton, turning it into clothing, and they're obviously using it over there and whatnot, and they're doing all this stuff. And that's one of the issues. We had the strife and the tension that created the U.S. Civil War. One of the issues of many issues was the South. They were getting hit with all these tariffs, and the North, well, they were more the financial, and they were doing service things, not just growing crops and whatnot. So that was a huge issue. So we had import and export tariffs up until the time of the Civil War, and then Civil War. Okay, we have a war, now we have to finance it. So then the U.S. enacts a income tax. Of course, the South seceded from the Union, so this is really in the Union part. There's an income tax, and then after the Civil War, there was a Supreme Court case that was determining whether the income tax levied during the Civil War, whether that was constitutional. And when it got all the way to the Supreme Court, guess what? They basically said it was no longer a moot issue because the war is over and there's no more income tax, so we're actually not going to rule on this. So finally, 1895, a Supreme Court case does rule on a tax and saying, hey, it's a direct tax, it's unconstitutional, so it gets thrown out. So basically, an apportioned tax is one based on census. We got to take an entire census of the U.S. Again, going back to our previous example with our Georgian and our Pennsylvanian, right? And we then say, okay, we have to make it more fair. It's not just, $1,000 from the Georgian, $100 from the Pennsylvanian. It'd be more like it'd be the same for each person. That's what we're talking about. We're talking about the census. As a tax on the income derived from the ownership of property was not based on census, it was unconstitutional. So again, it was a similar issue where you take, okay, there's an amount that has to come from each state. Well, there might be more people in Pennsylvania and less in Georgia, or there might be more property owners or less property owners. So that creates an issue, as you can see, just like the head count issue, which is easier to understand. So that's when the 16th Amendment was basically enacted. And the 16th Amendment, what it did was 16th Amendment to the Constitution in the early 1900s. And what it did was it said, well, now we're going to say that Congress can levy taxes on whatever source derived, does not have to be properly apportioned. So an income tax now, it works. Okay, so this is what allows a progressive system in the U.S. where people make more money, and guess what? They pay a higher percentage, right? Because if you think about our head tax with the Georgian $1,000 and the Pennsylvania $100, that's kind of in a way, it's not exactly the same thing, but it's got issues of, if you look at the marginal percentage, right, there's a much higher percentage to the Georgian than there is to the Pennsylvanian, and that's similar to what our progressive structure does, where people might have a higher marginal rate. All right, let's now go into the legislative process. So talk about history, and we'll talk more about history later on. Let's jump into the legislative process. This is very important. So you see here that we have the House on this side. We got Congress, right? Think back to your U.S. government class. If you haven't taken U.S. government, the legislative branch of the government is called Congress, and Congress is broken into the House of Representatives and then the Senate. So the House, I'll denote of H, S for Senate. Over here we've got the House, over here we have the Senate. Now, there's different committees within the House of Representatives and the Senate. For example, the House Ways and Means Committees deals with a bunch of different issues. One thing it deals with are tax bills. Senate Finance Committees deals with things like budgets and tax bills. Okay? There's committees on infrastructure and transportation and defense and international relations. There's so many different committees. You got to think about, a federal government, a large government like the United States. There's so many different committees out there, and the tax committees are actually, you would think they might be not as powerful committees to be on, but they actually are. They're very powerful committees for members of the House of Representatives or senators to be on. And they're one of the, you got some of the more senior members of the House and Senate on there, because tax is very important, okay? Now, it's important for tax researchers to understand the federal legislative process because it helps you understand multiple things, such as where it originated, the amount that was passed by, looking at different bills and what changed to reconcile the different things. The one thing I will say, you need to know this, is what's called origination. So all tax bills must start off in the House over here. So the origination must be here on the House. And what we're saying is that for an issue, a tax bill, some tax issue to be raised, it has to start here in the House. Doesn't mean it has to be the one that's passed. That could actually be here in the Senate, and we'll actually talk about that. The Senate lately, when I've been recording this video, and this could change based on when you're watching this in the future, the Senate has been actually driving tax legislation like crazy. Okay, and the reason why is at the time of making this video, the Senate is much more fit in terms of Democrat and Republican. Okay, and again, the future could have different names for our different political parties, but the idea is that you've got two sides, two major parties, and then it's pretty evenly split versus the House, not so much, not as much. Okay, so the House Ways and Means Committee is where the tax bills actually get proposed. And a senator might actually talk to a member in the House, and someone from the House, a House of Representatives member, has to actually sponsor a bill. So it has to be in the bill. It can't be like a senator goes over and brings it up. It has to be a member in the House. That's very important. So that's where you have all this horse trading and what goes on in political process and whatnot. The sausage making, as people say. So it starts off in the House, specifically House Ways and Means Committee. Then the House Ways and Means Committee, which is made up of a number of members of the House of Representatives, they then vote for it to then be proposed onto the floor of the actual House of Representatives. And if it actually passes a certain number of votes, then it will go on and continue on to the House of Representatives, which then they vote on it. Okay? Now, Senate Finance Committee, they also, after again it's been initially proposed in the House, they can then have their version. Doesn't have to be the same, it can be a different version of the bill. So as an example, Tax Cuts and Jobs Act of 2017. Perfect example, I'm going to use that as an example. And the reason why I use this as an example is because a lot of the issues we're going to talk about with the legislative process are involved in this bill. So Tax Cuts and Jobs Act of 2017 was enacted at the end of December of 2017. Okay, and the first proposal was by the House in September of 2017. And then the Senate came along in October and they then issued their version of a similar bill, but there was many differences, okay? So Senate Finance Committee, that's the version of the tax from the House Ways and Means. That's the Senate version. And again, they don't do just tax, they do budgeting, things like that, other issues as well. They then vote as well. And again, just like House Ways and Means, they have to vote and then it goes and it progresses and then gets voted on by the Senate. So if it gets passed, but there's differences, then a joint conference committee, they reconcile any differences. Okay? They reconcile the differences. And then what that joint conference committee does, and it's made up of members of House and Senate and various parties, and even the executive branch is involved, because you're going to see at the end, the president has to be involved, and the executive might be just kind of informally involved with the process. Informally, again, you have to remember the political process here. So that bill then gets brought to the floor of the House, floor of the Senate to be voted on, and then if it's passed, it's then signed by the president. If it's signed by the president, then it's incorporated into the Internal Revenue Code, that specific provision. Now, we're going to learn later that not all tax items get incorporated into the Internal Revenue Code, but almost all do. We're also going to learn exactly what you need to pass a bill when you get to that floor of the House and Senate, as well as what the president can do. They don't have to necessarily sign it. They can also veto it, and what then the options are. Okay, so let's just review kind of the process. So remember, origination in the House. It has to originate in the House. Very important. If you're taking a tax research class, very important to understand that. So bill introduced to the House, which the Ways and Means Committee, House Ways and Means Committee, is where it would actually be brought first. So there's going to be lots of public hearings and debates at the House Ways and Means Committee. So it's going to be approved at the House Ways and Means Committee. We're still there by a simple majority of the committee members. So if it's approved by a simple majority of the committee members, and I can't give you a specific number because, not all the committee members might be there. They might be absentee. They might be out for, various things, depending on the year. Just a simple majority. Then it gets sent to the floor to be voted on. So the bill voted on the floor of the House after the closed rule debate. Okay? What that means is that the closed rule debate means that in the House, once it's brought up, it cannot be significantly changed. They can discuss it, they can bring it up, but they cannot significantly add amendments to it. Now, if it's approved, if it gets voted on and it passes, it gets then sent to the Senate. I'll talk about what you need to pass a bill in a moment. So then the Senate version, they have their own item, their own version of the bill. They might change some things. Then they go through the Senate Finance Committee, and again, just like the House Ways, has to go through public hearings and debate at the Finance Committee level. If approved by a simple majority, then it's sent to the floor for the senators to vote. Now, the Senate floor is where you get a lot of the action. And again, at the time of this video, it's because the amount of senators that are one party versus another are very close, very close. So a lot of times we have obviously political pressures, But also, there's this rule that in the Senate, different senators can propose amendments that can change things. They can add on to things. So it makes the process much more involved. And the reason why this is, there's multiple reasons, but one thing, think about how many different representative members there are, House representative members, which there's a lot more than there are 100 senators. So there's only 100 senators, 2 from each state. And at the time of this video, it's 50 states. That could change in the future as well. And then you've got the House Representatives, which is over 200 people. So that could be a very long process, okay? So if approved in the Senate if approved at the Senate level and the Senate and House versions are similar, then it goes basically for a concurring vote by the House and then onto the president for signature. But that almost never happens. Usually what happens are the two bills, they are not the same, and then they have to have the joint committee, basically, the conference committee, basically get together and kind of reconcile that for then it to be voted on again. So if it's approved and Senate and House versions are different, then again, Senate to the conference committee to draft a compromise legislation, and then both have to vote on it. And voting, and we'll talk about this in a moment, voting, you need that, it's not just a simple majority, it's more than that. Unless you have what's called the Byrd Rule. So the Byrd Rule, which is also known as reconciliation. This is a special rule that deals with things related to budgets and finances and the government. And basically it says that you need a simple majority to pass a tax bill if you can you can balance that budget over 10 years. And there's other things to require, but you must at least balance the budget over 10 years with respect to that bill. And you're wondering, well, what do I mean by balance the budget over 10 years? You're like, well, the U.S. budget is, they're in trillions of dollars in debt or whatever. Well, with respect to the bill specifically, you have to look at the revenues that the taxes bring in versus the expenditures going out by providing tax benefits. And it has to balance over 10 years. So when you look at the Tax Cuts and Jobs Act of 2017, if you look up the history of that, and this is just an example, you can look up other examples as well, you will see that this Byrd Rule was followed. Because we cannot get a super majority, 2/3 vote, you needed a simple majority. You need to get at least over 50%, specifically in the Senate. That was where the biggest hurdle was going to be. And if you look at it, there's different provisions put in place to raise revenue, and there's different provisions in place to give benefits, like lowering the corporate tax rate. That, of course, is going to provide tax benefits, and that's going to be less tax that's collected. So if you look at over the 10 years, it's actually going to balance. And that's why if you look at the dates of the Tax Cuts and Jobs Act, it's within a 10-year period of when things sunsets, when different things sunset. Now, if you vote on, and again we pass, then it goes to the president to determine whether it will be signed. So the president basically has a few different things, and we'll talk about those in a moment, what the president can do. There's this interim period, basically the 10-day period between the date delivered to the president's desk and the day signed into law. Now, the Joint Committee on Taxation, they review the laws for errors and inconsistencies, and they determine. We'll talk more about the Joint Committee on Taxation later on. Concurrent resolution, the vote of House and Senate to ratify corrections within that 10-day period if there's any issues. So the Joint Committee is involved with that conference committee when you have the House bill and the Senate bill to put together the final bill to make sure to reconcile and any errors. So basically the purpose of this, you want an error-free bill signed by the president, make sure there's basically lots of checks and balances involved there. Okay, so if it does go through the House and Senate, then again, next part is the president. President has 3 possibilities that they can do. Make sure you know all 3 possibilities. President can sign it. President can veto it, which, by the way, if it's vetoed, then it can be passed by a higher vote. A higher vote. Okay, I'm not going to go into the specifics of that, just know a higher vote's needed. So the Byrd Rule, that wouldn't be able to, that more than 50% simple majority, that would not fly with the veto. And then the interim period, if the third thing is that basically, remember there's an interim period where the president has 10 days to decide what to do? A pocket veto, which what it means is that the president does nothing. The president does nothing. And if the president does nothing, then the bill becomes law unless Congress adjourns within the 10-day period. And if that's the case, then it does not become That is not the case, okay? So interim period lapse means that the bill does become law, so if nothing happens in that 10 days, the bill will become law as like a signature. So unless the Congress adjourns, which if the president knows what's going to happen, that's what's known as a pocket veto. They know they're going to adjourn. They pocket veto basically is like an indirect way to veto it. All right. So now we have this approved bill. The bill has been passed. It's gone through the House, gone through the Senate, gone through the executive branch, and now it's legislation. So this bill is now considered part of the U.S. statutes, statutory law. Now, U.S. statutes are broken down in different codes. Specifically, tax law is Title 26, but there's other bankruptcy. There's a bankruptcy code. There's different U.S. codes out there that deal with different areas of law. Okay, we're obviously focusing on federal tax law, so Title 26. It's broken down and codified into topic and assigned a title number. So tax law all goes to Title 26. If it was bankruptcy, it would go to a different code number. And you're going to see the breakdown. Title is the highest level of a U.S. code, right? Title 26 is the highest level. We're going to then break down that into different levels: subtitle, part, subpart, paragraph, subparagraph, section, and subsection. Make sure you know that breakdown. If you're taking a tax research class, whether it's my class or another faculty member, I guarantee that at some point they're going to test you on the breakdown of the structure of the U.S. code. So make sure you know that structure. Very important. Okay? It's like an outline format. We're going to look more in depth. So Title 26 of the U.S. code is commonly known under what topical name? The Internal Revenue Code, IRC. So whenever you hear of the IRC, we're talking about Title 26 of the U.S. Code, okay? Title 26 of the U.S. Code, the IRC. So if you ever see someone refer to the IRC, that's what they're talking about. The Internal Revenue Code, Title 26 of the U.S. Code. All right, so we talked about different bills. And one thing that I wanted to raise is that I said that, okay, once you have a bill, it's been passed, then it goes into the code. That's not 100% true. It's only 99% of the time it's true. So to codify or not to codify. So tax legislation that becomes law is given a name. So an example of a bill that was passed was the Tax Increase Prevention Act of 2007. Another example is the Tax Cuts and Jobs Act of 2017. That's another example. Or the Tax Reform Act of 1986, Tax Reform Act of 1954. Okay, there's different names for different bills. Okay. All tax legislation generally is included in the Internal Revenue Code and may be found by a section number. That's, again, that 99% rule. So it'll be found under a section number. We'll talk about the section numbers because that's the lowest level. It has to fit under that section. Sorry, subsection is the lowest level, but section is kind of that unit where you get that, where you're starting to get towards the lowest level. Now, some tax acts are not codified. Why are these rules not included in the Internal Revenue Code? And where does a tax practitioner find them if doing research? So one thing is that you might have a tax bill that's been enacted, but it's not going to be updated in the tax law, the tax code, because it's going to take time, right? It might be passed in 2017, but it might not take effect until parts of 2018, so you won't see that necessarily adjusted in the U.S. code until it actually is effective. Also, sunset provisions. There's many provisions in these tax bills that basically they renew tax codes and they don't get put into the actual tax code itself. So that's the example. That's usually where you find the most of those things. Finally, effective dates. That kind of transition rules and effective dates are kind of similar. Again, you've got these rules where you're going from, okay, you've got a bill that passes but doesn't come effective until a certain time. So I would kind of classify those. But the sunset provisions are very common. Many bills you're going to see over time, different provisions, they kind of like, okay, they're going to sunset at this time. And when you get into tax law, you'll learn about these different deductions, different items. They aren't permanent. They're temporary and they're going to sunset, we call it. Sunset means that they're going to go bye-bye. Well, the bill will renew those, but they don't get necessarily, you don't see the same language brought into the code. All right, so now let's get to the organization. I mentioned earlier that this presentation, we're going to really focus on the Internal Revenue Code, and one of the most important things is the organization. Very, very, very important to understand the organization, and you have to actually know it because you could be talking to a partner or a shareholder at your accounting firm or law firm, whatever it is, or you could be dealing with a client before the IRS, and you got to know the level. Oh, and we also refer to different areas of the law by subtitles, subchapters, so it's very important. So again, title is the highest point, and Title 26 is a U.S. code dealing with taxes, the Internal Revenue Code. So below that, we've got subtitles. Now, most research is done in subtitle A because it focuses on income tax, specifically the research that I do and what I do in my research class. Now, there's also subtitle B, which deals with estate and gift taxes. There's also subtitle F, which deals with procedure administration. There's another slide you're going to see in a moment. It says see slide 14. Just ignore that. Sorry. I renumbered these, so you can ignore that 14. Just see slide later that deals with the subtitles, some of the main ones, and you should really learn those. If you're taking my class, you definitely need to learn those. So then next, after title, is chapter. So then we have chapters and subchapters, and we'll talk about some of those. Again, just see slide later on. Ignore those. I renumbered these. My apologies. And then part and subpart is next. So we're going down. And then section and subsection. So again, and if you want to create a flashcard, you can learn this. And once you learn it, it's like riding a bicycle. It's always easy to remember. You've got title, subtitle, chapter, subchapter, part, subpart, section, subsection. Okay? So once you get past the title, then everything is alphabetical. If you remember the 4 levels, right? Title, well, there's also sub-levels, but if you have the 4 main levels, right? You got title, chapter, part, and section. Just remember that title is always at the top. Then what comes next is going to be the alphabetical of the 3 remaining, right? You've got chapter, which is C. You've got part, which is P. And you've got section, which is S. Okay. Obviously, you have the subs, but again, those are subs of those main levels. That's how I always remember it, right? So you got title, subtitle, chapter, subchapter, part, subpart, section, subsection, right? We've got 8 different levels: title, subtitle, chapter, subchapter, part, subpart, section, subsection. Maybe pause the video and just go through that a few times, right? You know that rule of 7. If you say things 7 times, it helps your brain to remember that. Just go through it, right? And then once you get to a point, you can say it fast enough, right? Title, subtitle, chapter, subchapter, part, subpart, section, subsection. You will eventually get the hang of it and remember that. Now, when you start actually diving into areas of tax, it'll also help you remember, because we all just know, okay, well, Title 26 of the U.S. Code, we know that is, of course, the Internal Revenue Code. But then to differentiate, we know that sections are, again, those breakdowns, and then differentiating between a chapter and a part, that we know there's different subchapters of various income tax areas. That's how we know that chapter comes before a part. So as you do more of tax, you get the hang of this lingo and the structure more. Okay, so here are some of the most important subtitles. Now, if you're taking my class, I would say that you definitely need to know subtitle A is the income taxes. Subtitle B is estate and gift. I would say know subtitle C is the employment taxes. I would also know procedure administration is subtitle F, right? The other ones, not as important, but you might be taking, they're still important, right? But these are the main ones, right? The A, the B, the C, and the F. And that's because in tax practice, we deal a lot with these different things. You might go into a profession that deals with excise taxes, or so you might actually deal with things like D and E later on, but most tax professionals, they deal with these, A, B, C, and F, and usually they focus on A, maybe F for a procedure. Maybe you have an estate planner that deals with B. Employment taxes occasionally comes up, so you have C as well. But these are the main ones. Definitely know those. So here are some different chapters. And honestly, in tax law, we don't really spend too much time referring to different areas of law by the chapter. We do use subtitle for income tax procedure. We mostly, what you're going to hear is subchapter and subpart. Those are the main ones. So here are some examples of some chapters. You can just take note of these, but really not as important as what we just saw in the subtitle. All right, so this one's really important. This one is really important because now we're getting to the nitty gritty. And if you're taking my class, you definitely need to start understanding this. So remember, we are dealing with Title 26 of the U.S. Code. So Title 26, and that is the Internal Revenue Code. Next is we're going to have, next level is a subtitle. So we're going to be focusing on income tax just for this example, but of course there's other areas, right? You could have subtitle on estate and gift, procedure, but let's focus on income tax. That's where I spend most of my time. Notice it gives us the code sections. And by the way, this could change in the future, so don't key in on the last one, but it starts with section 1 and it goes all the way to 1564. Next level is chapter. So chapter 1 on normal taxes and surtaxes. And again, it breaks down the number. So within chapter 1, we have subchapters. And this is very important. If you're taking my class, there are many subchapters you need to understand. So subchapter A deals with termination of tax liability and gives the section numbers. Subchapter B gives the computation of taxable income. That's where you're going to find our definition of gross income, our exclusions from gross income, deductions that apply to all taxpayers, right? Very, very important. I have top 100 code sections that really go through this, but this is that structure, very important. Subchapter C, this is where we find the general rules for corporations. So here's our general corporation rules. Subchapter D is what we call deferred comp. So things like 401ks, you've got different deferred compensation plans in there. Subchapter E, we find accounting periods and methods, so the 440s to 480s. And by the way, you see these code section numbers? That does not necessarily mean that every code section has a provision in it. We keep these organized so that Congress can come in and put more stuff in within that grouping. Okay, so just because you see 441 to 483 doesn't mean you're going to find a section 450 or even a section 449 or 459. Doesn't necessarily mean. You will generally find a 441, a 451, a 461. That is the case. But again, not every code section you will find something. And again, it's because they're structuring it a certain way for different topics. Because we're going to have subchapter, then we're going to have parts, subparts, right? So we need, again, more organization below this. Subchapter F is going to be exempt organizations. Subchapter G, we can avoid that. H is banking. I is natural resources, not that common. J, estates, trusts, beneficiaries, and decedents. This is not the same thing as estate and gift tax. This is income taxation of estates and trusts. So forms 1041, when you have to fill out the income taxation of estates and trusts, that's what we're talking about right there. We're not talking about the form 706 and form 709 for gift tax return and estate tax return and all that. That is going to be found in a different subtitle, not the income tax subtitle. We've got subchapter K, one of my favorite topics, partnerships. So the general rules for partnerships are found here. Now something to note, and many of you might already know this, just if you have a partnership, you'll find other tax rules and other provisions. Specifically, you'll find rules that apply in subchapter A. In subchapter B, you might find them elsewhere. In subchapter E, you will for sure find them there because those are general rules that apply to all taxpayers in those groupings, unless specifically told otherwise in the actual section. Subchapter L deals with insurance. M deals with RICs and REITs. So that's really specific. N deals with international tax. O is one of my favorite topics. You're starting to get into property transactions. So sales and dispositions of property. P is the characterization. So this is, like sale, exchange of property. This is another area where I gave the example of partnership isn't just in subchapter K. It's also in subchapter P and O. Subchapter P is characterization. So when you learn about section 1231, 1245, capital gain, capital loss in 1221, 1222, 1223, boom, all there. Okay? And then look at this. Subchapter S, that's where we get S corporations, also known as small business corporations. And by the way, subchapter C is called, that's where you find the general corporation rules, but that's why we actually call it a C Corp, because the general C corporation rules, they apply there. Subchapter Q and R, those are special provisions. So make sure you know, I would say the ones that are really rare, I'll put like a triangle next to those. G, M, and then Q and R. I would say make sure you know these other elements because you might come across these in practice. I'll put some of the other ones. Banking, you're not really going to see banking much. Natural resources, I'm teaching this in Florida, but you might be taking it out there, and you might be taking a course in Oklahoma or Texas or Louisiana, natural resources. Insurance companies, the firm I actually work for has actually an insurance company practice, but not many of you will be dealing with that. All the other ones, so if there's a little line next to it, make sure you know these, right? So subchapter A, B, C, D, E, F, J, K, N, O, P, S. These are all really important subchapters of the subtitle A. And if you're taking my class, I would definitely know these. I would definitely know what they apply to. Okay, definitely know what areas they apply to. Very, very important. The triangle ones, they're still important, but for my class, not as important. All right, so one thing that I didn't talk about was the parts. And again, parts break up different topics. So if you go back to the subchapter, then we have parts and subparts. So maybe within like the timing rules, let's take an example, corporation rules. The first rules you're going to have in the 301 to 309 are going to be dealing with distributions. Then 310 to 319 deals with calculations of EMP and distributions as well. And then 351 to 359 deals with formation, the effects of the shareholders. So there's parts and subparts that break up different topics. Okay. Now sections are extremely important. I have some videos that deal with the top 100 code sections. Okay, if you're taking my tax research class, there's another module later on this, so you're going to learn about it. But I have what's the top 100 code sections out there that I kind of quantify for you why they're so important. I explain. Also, I talk about the different themes in the tax law that you need to know that help you kind of navigate the tax law and understand it, because you can't memorize all this stuff. Plus, it changes all the time. But understanding the themes helps you keep everything in line and be a great tax professional and practitioner. So section numbers are the most important division of the Internal Revenue Code. So when you talk to other tax professionals, you're usually referring to the section numbers. Oh, it's a section 351 transaction. Oh, that's a 1231 gain. That's a 1245 recapture. There's so many different, the section 453 installment sale. You use section 1031 exchange. There's different section numbers that we use to denote different things. And these section numbers are for the entire code. They don't start over for each one, okay? Just so you know. So you will see that, and you'll see on that list that it's the section number is so important. It's like the key. It's like you're keying in on that topic, so it doesn't start over. There's not multiple same section numbers in the U.S. code. There's different ones. So it's by far it's the most important division of the Internal Revenue Code. By far is the section number. And again, each section number is only referred to once, so there's no concern about duplication. So you won't have a section 1 in the income tax subtitle, and you won't have a section 1 in the estate tax. No, it's a different number, okay? You're going to have section 1 starts income tax, and then for estate tax, you're going to have section 2001 what starts estate tax. Common element of jargon of code section for researchers, practitioners, as I mentioned. Now, we're going to look at the breakdown of the code, and you're like, oh man, I just had to learn those 8 different elements of breaking down the Internal Revenue Code. I'm going to have to learn another organization for a section? Yes. And that's what makes this so difficult, the tax law so difficult. But hey, every research class in America, you got to learn this. And you will be tested on it. It's very, very important. It's very important because if you mislabel, you could be talking about some completely different exception or different rule. And as you get into the Internal Revenue Code, you're going to see that some provisions, some code sections like section 199A are just super long. So it's very important when you're providing to doing research that you are as specific as possible, so you can show exactly where you're getting the rules that you're bringing up. Now we're going to talk about flush language later on. And flush language is always a nightmare because it's hard to reference flush language because you could have multiple flush language in the code section. I'll show you what I mean. Now, there are exceptions to general formatting. Generally, Congress, they give, section 1, section 2, section 3. And again, you might have there might not be a section 4. There might not be a section 2 or section 3. But one thing is that if there's a section and Congress can't fit in a topic that's similar, they will start giving letters. And a perfect example of this is if you look in section 280. In 280, you'll find a 280A, 280B, and so on, right? You'll find these 280, and we call those Cap A. So, for example, 263 Cap A is not the same as 263 subsection A, okay? And we're going to look at the breakdown of a section, but just keep that in mind. If you see 263 Cap A or 280 Cap A, that is a section number. That is not saying 263 subsection A. And again, that shows you why this is so important, how you label this. All right, here we're at it. We got to it. Here is breaking down the structure of a section. Again, section is by far the most important thing when it comes to these different units. Here is the breakdown of a section. And if you're taking my class, you got to know this all the way down. You got to know it all the way down. We're going to learn about regulations in another module, another video, and they have their own breakdown as well, but they also follow this very similar. So, hey, once you learn this, you'll be good for later on. Okay. And by the way, do not rely on this language because the law has changed. But this is section 121, exclusion of gain from sale of principal residence. That's the title. So here are our different items. So we've got the section number 121. We've got subsection. Then below that, so we're going down, we've got paragraph, subparagraph, clause, subclause, okay, all the way down. Okay, so here's an example. So we've got section 121, exclusion of gain from sale of principal residence, and then the subsection actually is titled exclusion, and they provide some language. So that's subsection A. Subsection B, so same level as subsection A. These are the same level. These are the same level. It's not below, it's the same level. Limitations. Then we go down one to limitations. So now we go from section, subsection, now we go to paragraph. So this is section 121, subsection B. And by the way, the way I'm saying this is how we actually say it. Paragraph 1. This is paragraph 2. Look here. We're going down even further. Okay, so we got section 121. We have subsection B. We've got paragraph 2, then we've got subparagraph A, and look here, we got another one. Now I've got clause. Clause 1. This is clause 2. This is clause 3. And you can have below that, you can have a subclause. By the way, you see this A with respect to such property? No, that's not within that. It will break it down. It will actually break down, the next one you probably will see will be a big letter 1, big letter 2, like that. That's usually next. That's usually a subclause, how they denote that. Okay? But that is the breakdown. Okay? You can see that. Then we've got D, which is a subsection. It goes back up to that level. So again, you're going down the line. So again, I would personally, you got to learn this. Keep saying it over and over again. Do flashcards, whatever. We start with section. Section to subsection. Then paragraph. Then subparagraph. Then clause. Then subclause. Okay? After that, usually we say big little, big A and all these different things, because after clause, that's usually what we usually go subclause, and then after subclause, at that point, it gets really nitty gritty. But this is usually after this level, after subclause, that's usually for most provisions how the lowest you get. Flush language. If you ever have a paragraph that just kind of busts out and it's in its own area, that's flush language. What we do is we cite the closest provision to it, and we say, hey, it's the flush language within D. So we would say, hey, the flush language of section 121, subsection D, paragraph 7, subparagraph B, flush language. We actually would say that because it's immediately after that provision. Because there might be other flush languages that occur in this section 121, which I can tell you there are. So we cite to the previous source above it. That's how we do that. So make sure you go back over this. So again, you got to break down the structure of the actual Title 26 of the Internal Revenue Code. Now you got to break down the structure of a section. Okay, where to find the Internal Revenue Code? Now, I've mentioned in previous research videos that I always recommend using subscription services like Checkpoint, CCH, Bloomberg BNA, Westlaw, Lexis. And that's because they keep the most up to date There are some free resources out there, but they might not update the Internal Revenue Code as quickly as they need to. So you can find a free Internal Revenue Code at Cornell University Law School just by going to, if you just actually go into a search engine and search Internal Revenue Code or IRC in the section, usually what comes up first is the Cornell University Law School library site where they actually have that. And again, this does get updated, but it's not near as quick as these paid sources. Okay. Also, you can find it on the uscode.house.gov website. Again, majority tax services, that's probably the best. And then occasionally, you may have to refer to stuff before the Internal Revenue Code 1939, which we're going to learn. I'm going to talk about the history in a moment, is all through bills. And for those, honestly, I recommend using the tax services because it keeps it all straight. Okay, here are some helpful hints when you're researching. So when you're going through the Internal Revenue Code, the structure, as we saw with Section 121, you can go back to that previous discussion. It actually said, the naming of the actual provision, right? It said, sale or exchange of principal residence as it's labeled. And then it said subsection A, right? And then it provided a rule. And then we actually saw exception or we saw limitation, right? It actually kind of gives an idea. So there's general rules, and general rules aren't always at the top, but usually they start off at the top. And then as we go below, we have exceptions to the general rules, and then of course exceptions to the exceptions. Now again, it's not always in that format, but as many of you know, the tax law, there's so many different exceptions to the general rule, and there's exceptions to the exceptions. So always keep that in mind. Always keep that in mind. An area where you can see some of these exceptions that I like to use as an example deals with alimony and child support. So if you go to the code section that deals with alimony and child support, section 71, you'll find the general rule that depending on so I know alimony depends on the year, but before the Tax Cuts and Jobs Act of 2017, alimony was included in gross income. Now it depends on the year, okay, and other things as well. It was included in gross income. That was the general rule. There were exceptions to that. One of the exceptions was child support. Child support was not included in gross income. Okay, so that was an exception to the general rule that alimony is included in gross income. So that's kind of the idea we got here. And then you got exceptions to the exceptions. You might have something called child support, but if it does X, Y, and Z, then it's actually going to be in gross income. So it actually takes it out of the exception. Okay. Now, throughout the provisions, you're going to see definitions. We also saw that in Section 121. There's a definition provision, okay? Now, they usually are found within the code section, but there's times where there's actually code sections that refer to definitions themselves. For example, when you can definitely write down this code section. It's by far one of the most important, definitely on my top 100 list, Section 7701 of the Internal Revenue Code. And there's lots of different definitions that you can find in here. And basically the idea is that if you can't find a definition within the code section, go to 7701 because usually you find it there. There might be other areas where it's defined, like the regulations or whatnot, and there might actually not be definition. You might not find the definition of something, okay? There's various cases of, for example, property. Property is not defined in the Internal Revenue Code. Case law defines it, but not property, okay? So you might have to actually look beyond the code for case law, for regulations, for different things. Now, language, and we're going to talk more about this when we go over in the top 100 code section video where I have the themes in different areas so we can actually look at the language. Be careful with words that modify percentage or dollar amounts, such as less than and not less than. So when you're looking at the actual code, you got to look at the language, right? It actually defines, and again, my video on the top 100 code sections will go through this. Also distinguish things like 30 days versus 1 month. We know it's different, right? Because some months have more than 30 days, like 31 days, right? 30 days have September, April, June, and November. All the rest have 31 except February, right? So that's the idea, is that 30 days is different from a month, because if it says a month, okay, well, you might be in the month of July or August, which have 31 days when you're dealing with this tax issue. Connectors. This is a very important element. Again, we're going to talk about this in the top 100 code sections, but this is very, very, very important. I always have to stress this. Connectors. Basically, if you've taken like an English class before, you might remember like diagramming sentences. Tax law a lot of times is like that as well. You might have and language versus or. And with these exceptions and these rules, you might have requirements. For example, to have alimony, you have to have various things. And you'll see that in the definition for alimony, there's various items, different requirements, and you're going to see it's and, not or. Not or. You need all of those. You need all of those requirements. You have to meet requirement 1, 2, 3, 4, 5. Not or, where it could be any of those 5. Different rules have different things, different exceptions, different ways to get and versus or. It actually says that. So connectors also can be hidden at the end of the previous clause or paragraph. And again, and means that all phrases connected by and must be true. Giving the example of the alimony where all of those items have to be true. Or means that, hey, if you have one of those items, you're good. Okay? Effective versus enactment date. Perfect example is the Tax Cuts and Jobs Act of 2017. So Tax Cuts and Jobs Act of 2017 was enacted at the end of 2017, December of 2017. However, some of the provisions in the Tax Cuts and Jobs Act of 2017 actually applied before that date, all the way back to September of 2017. Or some provisions actually applied in the future, like in 2019, not 2018 like many of them did. Many of them started on January 1st, 2018. Some started in 2019 or future years, or things changed later on. So we follow the effective date of a provision, not the enactment date. We don't say, oh, as of that date when it was enacted, everything is true. No, that's not how it works. It's the effective date. Be aware of temporary transition rules, followed by an abrupt change to the code, okay, if they're eased in. And again, Tax Cuts and Jobs Act had this as well because there was, different phase outs that happened over time, like the ulterior minimum tax credit that goes along with that. It was basically being phased out over time. Many code sections have cost of living adjustments, and the tables are found outside the Internal Revenue Code, usually through a rev proc or a notice by the IRS, and we'll talk about those. We'll talk about administrative sources. Some legislative code sections expire at a set date, sunset provisions, and we talked about how, hey, bills can make those come back. Researcher may need to look outside the code for tax treaties, administrative rulings, judicial decisions, secondary sources, and that's exactly right. Tax research isn't a vacuum. It's not just these code sections. It's other things as well. The code is just simply where we start. Let's talk about citing the Internal Revenue Code. So in our previous slide, we had section 121, right? And that was the section number. And we went down, we broke it down how it is, how that actually is the organization of the section. We're using that same organization when we actually cite. So we start with the section number, section 121. If you want to go back to that previous slide, you're going to see how this works, right? Same things. Nothing's new. It's not magic or anything. Nothing's coming out of, it's all from that slide. So we say section 121, subsection B, paragraph 2, subparagraph A, clause 1. Right? That's actually how we're going to cite it when we do our citations for our various legal research memos. So we actually are going to cite it that way. And I have video on how to write a tax memo and the citation structure. You can see that. But that is how we cite that. And if you see a citation like that, that's not, some hieroglyph or something. You can translate that. We're saying, hey, this is found in section 121, subsection B, paragraph 2, subparagraph A, clause 1. And that's exactly where you should be able to find that whatever that statement is supported. Now, I remember I told you that organization structure is still, we always follow. We say section, subsection, paragraph, subparagraph, clause, subclause, right? That's how we do it. What I was saying earlier is that it's not always going to be little b, then 2, then big A. It's not going to be in that exact format. For example, section 212. Section 212 is written, it just starts off. In the case of any individual, there shall be allows a deduction all the ordinary and necessary expenses paid or incurred during the taxable year, and it lists 1, 2, and 3. All right, let's talk about tax treaties. So we've been focusing on the code, and we'll come back to the code in a little bit, especially talk about the history. But I want to talk about tax treaties. And I want you to note that this is not the same as a treatise. We're not talking about tax treatises. Tax treatises are secondary authorities where experts in the area have provided various rules. They basically summarize an area of the law. Not the same as a tax treaty, okay? So tax treaties are also known as tax conventions. And basically what they are between the U.S. and other countries, providing special rules special rules. And basically the main purpose, there's multiple purposes, is to eliminate double taxation from incomes subject to tax in both countries. So if you know anything about international tax, most countries use a territorial tax system. But the US has a modified territorial tax system, and it's actually, sorry for the spelling if I misspelled that. You get the idea, territorial. It's actually more like a worldwide system. So US has a modified territorial system, and it's actually more like they tax everything in the world. All income from whatever source derives goes into the US, and that's been modified over the years through different income tax laws, international income tax laws. But the idea is it's possible without these treaties to be taxed in both US and another country. Like if you live in the US and you work in Great Britain, England, you might be taxed in both based on the rules. So these treaties, they provide ways to avoid double taxation. They're usually negotiated under the Department of Treasury and the Senate. The US may have multiple treaties with one country dealing with multiple tax issues. When researching treaties may also be titled by conventions. Amendments are known as protocols. Treaty departments will issue technical explanations to interpret tax treaties. Senate executive reports are generated on treaties at times. And tax treaties can be found on the IRS website if you search for the different treaties. Here's more information about treaties. Again, the main thing that treaties deal with is the avoiding of double taxation. Here's some common issues addressed in U.S. tax treaties to get that. How business and investment income is treated. When foreign persons subject to the host country's tax law. So when are they subject to that? Methods to offset double taxation of income or assets. How the host country computes taxable income for a foreigner. How the host country's withholding taxes apply to the foreigner. Taxes levied by states or provinces on the foreigners. Disclosure requirements applied to foreigners. So tax treaties can be difficult to cite. The way we cite them, and I don't really do much with tax treaties in my tax research class, but you might have a teacher that does. We cite the treaty title, the signing date, not the effective date, the parties, subdivision, or article, and the source. Now in a later video, we're going to talk about what happens if you have Internal Revenue Code versus a treaty, which takes precedent. So we'll talk about that because as many of you noticed in my previous introduction to tax research, they're both a 2 on the list of 1 to 10, how authoritative they are. So that will be addressed in a later video. So make sure you watch that video. All right. The last area of legislative source is legislative intent. So we have the Constitution, the Internal Revenue Code. We've been spending most of our time on the Internal Revenue Code. We talk about tax treaties, and we have got legislative intent. So legislative intent, we're talking about the different committees and different parties involved in actually enacting the provisions. And we're talking about also on the floor of the Senate, the House, what was said, what was discussed, what was debated. So we have the House Ways and Means Committee report. That's issued by, of course, the House Ways and Means Committee when they're drafting a tax bill. We've got the Senate Finance Committee report. We've got the Conference Committee report. And you've got the Joint Committee on Taxation report, which is also known as the Blue Book. The Blue Book is used a lot in tax research because it does provide a lot of the intent behind that, behind the actual provisions. All right, let's talk about history, one of my favorite topics. Specifically, let's talk about the history of the Internal Revenue Code and some other legislative items. So the 16th Amendment is ratified by the states, right? 3/4 or more vote in 1913. So we've got the U.S. income tax law coming about then. So from 1916 to 1939, Congress passes a total of 17 different revenue acts devoted to taxation. These were all independent pieces of legislation as Congress did not bother to eliminate inconsistencies, deadwood provisions between the different bills, or modify different items within the acts. So between 1916 and 1939, researching tax law was a nightmare because you got these 17 different tax bills. You got to go into all 17. So Congress resolves this problem in 1939 by merging all of the acts into one Internal Revenue Code of 1939. So Title 26 of the U.S. Code, our first Internal Revenue Code, is in 1939. 1939 of our first U.S. Internal Revenue Code. And basically it took the bill and it put it all together, all the rules. Okay, so from 1939 to 1954, we've continued with that 1939 Internal Revenue Code. By the way, between 1939 and 1954, lots of cases, lots of changes in the tax law. There is a Tax Act in 1954. Huge provision. So big that it reorganizes and changes a lot of stuff in the 1954 tax code. Okay? So our second Internal Revenue Code is in 1954. And by the way, I have a video that talks about the introduction to U.S. income tax, or U.S. tax, not income tax, U.S. tax, and it goes over the history of these dates. It talks about the second Internal Revenue Code, and it also talks about kind of the thinking of the taxation, looking at policy and stuff on these dates and how it changes. So this is the second Internal Revenue Code, which is in 1954. So the recodification in 1954, it's important for tax research. And the reason why is because if you're looking at a case before 1954, you might see a section number and you're like, oh, well, that's not the section I'm looking at. For example, Section 17J of the 1939 tax code is really Section 1231 under the 1954 code, which also keeps the same in 1986. So the 1986 code, we're going to talk about that next, which is the third tax code, that kept the tax code numbers the same. It didn't recodify in different numbers like it did for 1954, like it did in 1954. But the idea is that, hey, if you're looking at a tax case in, 1946, and it references 17J, well, that's the same as Section 1231 in 1954 and later. That's the idea. Very important for tax research. Then 1986, we've got our third tax code, because the tax law changed so much that the philosophy changed from more of a wealth redistribution to more of just raising revenue. That's why we have a lowering of we have way less tax brackets, tax rates, way less. There's just so many changes in more of a philosophy of raising revenue rather than just wealth redistribution. And by the way, 1986, third tax code, at the time of this video, we're still using the third tax code, but in the future, there might be another one, because if there's a huge change in the tax law, it could change that. Now, 1993, 1996, 2001, 2004, 2017, and going forward, there's some major tax legislation, especially 2017. But none of them, there was not a new tax code. We used the old 86 tax code. We just amended it. So it's still the 86 Internal Revenue Code on those dates. That's how we think of it. And you will know when there's a new tax code, because Congress, they will say, oh, here's the Internal Revenue Code of 1986. Here's the Internal Revenue Code of 1939, 1954. So right now, at the time of this video, it's still the 86 Internal Revenue Code where we amend for different tax provisions. But if there's some change in the future that completely changes our system, we could see a new Internal Revenue Code. Let's talk about evaluating primary legislative authorities. So we talked about the Constitution earlier, and it's important to note that the Constitution is the most powerful document in terms of U.S. law. All tax legislation must be constitutional to be valid. We talked earlier about direct versus indirect tax and the issue of the person from Georgia versus the person from Pennsylvania and how that all played out. Before the 16th Amendment, that was a serious issue. But after the 16th Amendment, we now know that Congress has pretty much ultimate power in terms of bringing tax on these parties. And if you look at the language of the 16th Amendment, it actually says, from whatever source derived. And when you look at the broad language of Section 61 defining gross income, you see that same language, from whatever source derived. And people always wonder, why is Section 61 so broad? Two reasons. Because one, we need to keep it broad so that way gross income in the future, when we don't understand things like Bitcoin, they didn't know about Bitcoin, back in the 1950s, right? Mining Bitcoin, how that could be interpreted as gross income. Well, we need to keep that broad so that we can encompass those things in the future without providing just a specific list, right? Second is because that's the constitutional power granted under the 16th Amendment, and Congress wanted to use the entire power in terms of taxing income. So they use that same language. So keep that in mind. The Constitution is the highest level, and it provides that ultimate authority. However, when it comes to tax law, specifically legislative sources, the Constitution is rarely looked at when it comes to tax provisions. The ultimate authority for any tax issue is going to be, you start that Internal Revenue Code. So we always start there. Now, tax acts, which are not included in the code, we talked about those earlier, those have the same authority as the Internal Revenue Code because they also are legislative. They've been passed. They've gone through the legislative process. Tax treaties, also the same level as the Internal Revenue Code. Legislative intent, though, is not the same level as these items. So keep that in mind. I actually have some slides we're going to look at and how we weigh these, right, on the scale of 1 to 10. And I went through this in the Introduction to Tax Research video. You can go back over that. Remember that 1 through 5 are binding, and then 6 through 10 are non-binding. You will see that the legislative intent, they are non-binding. But they can still be relied on in terms of the substantial understatement penalty that of those 1 through 10 items that I talked about in that Intro to Tax Research video. Let's go ahead and go through that in the future. So the first item we have is the Constitution. On a scale of 1 to 10, again, Constitution is the highest law of the land, so it gets a 1. And again, it's a legislative source. All of these are legislative sources, so you'll see the L there, which means legislative, but the thing to key in here on is that it's a 1. It's the highest it can be. Next, we've got U.S. Code section. Again, legislative. All these are legislative. It's given a 2 because even though it's the most important area in terms of tax law, tax items, right, Title 26, U.S. Code, it's not as powerful as the U.S. Constitution. That's always the highest. And we talked about the U.S. Code and the organization, all that stuff in this video. Note that, again, tax acts also go under that U.S. Code section at same level. Next, we have the U.S. Treaty. So treaties are also 2, and we talked about those. Now, when the 2 are in conflict, courts usually assume the one adopted later, right? The one that's been enacted later, adopted later, that actually is going to trump. So if you have a treaty and a code section, they both deal with the same issue, but they provide different results to a taxpayer, we go with whichever one was adopted later. That's the one that controls. All right, now we're getting into those legislative history items. Again, they're going to be a 6 through 10, which means they're not binding, but they still are persuasive. They can be relied on. So we got the committee report. The committee reports are of the various congressional tax committees, the House Ways, Means, and Senate Finance and Conference committees, and they're written contemporaneously, and that's going to be very important. That's going to make the difference between whether something is an 8 versus a 9 versus a 10. If it's contemporaneously written, it's written when the actual process is going on, that makes it makes it more weight than, let's say, the other things like the Joint Committee on Taxation report, the Blue Book. With legislation and are useful indicators of congressional intent. So these are written actually as the process is going on. Maybe it's a stenographer taking notes, what's being said while people are being interviewed and while a congressman is saying while they're on the floor talking. It's a stenographer notes, actual transcripts. Committee reports may not be used to overturn the plain meaning of the words in the statute itself. They can only be used for the intent behind the actual provision. And that's why they're not binding. Here's the Blue Book. Blue Book, of all of the legislative history sources, Blue Book is by far the most referenced. So Blue Book, which is also known as the Joint Committee on Taxation report, is often regarded to as the most comprehensive and lucid explanation of a new tax law. So we go there to kind of get an idea of what was going on. And it doesn't have the same weight as the committee reports because those are written contemporaneously. This is not contemporaneously, meaning it's not written at the same time. Just realized that I completely butchered that word, sorry. Contemporaneously. There you go, it's better. So this is not contemporaneously, meaning it's not written at the same time as these things are going on. These committees are meeting and they're hearing they're hearing witnesses and the Congress people are talking and discussing these things. It's actually done after it's been enacted, giving more detail on the bill, what's going on, all these different things. So over the years, the courts have traditionally accorded this document less weight than other sources since it's not written contemporaneously with the legislative process. More importantly, there's no opportunity for Congress or anyone else involved in the legislative process to rebut the Blue Book's conclusions. Versus in the committee reports, right, there was one congressman might have stated something, and then for the record, they might have stated something like, oh, I disagree with what you're saying. I actually enacted it for this reason. So it allows that. However, the following 2 recent events have tended to provide more authority for the Blue Book. The first is that the Blue Book is now listed on the substantial authority. That's why it's number 1 through 10, right? Because it's on that substantial authority list for avoiding the section 62 penalty. And the U.S. Supreme Court stated the following in FPC versus Memphis Light concerning the Blue Book. It provides a compelling contemporary indication of the legislation's effect. So in that case, the court afforded more weight to the Blue Book than some other courts. Again, remember, these weighting systems of 1 through 10, it's not perfect, right? Different courts have viewed these things differently, but I would say a 9 is what I would give the Blue Book, because in some cases, courts have just completely thrown out the petitioner's argument, or the argument that they should use the Blue Book or look at the Blue Book. I think, but other courts have relied on it. So it just depends on the court sometimes. It depends on what they decided that day. Finally, the last one is a congressional record. So this is not as strong as the Joint Committee on Taxation Blue Book or the committee reports. I would say that this is kind of like the unfiltered version of the committee report. Committee report basically takes congressional record and it kind of like puts it into stuff, and it's written at the same time. These represent discussions between members of Congress and managers of a tax bill that are intended to clarify specific provisions. As a general rule, colloquies and floor statements may be relied on only in the event that statute or committee reports fail to yield any insight into congressional intents or their actions. So I mentioned earlier the congressional committee reports might have expert witness testimony or different senators, but this is actually on the floor. So if I said earlier the floor, I didn't mean on the floor. This is the floor, from the actual floor itself, the discussion. But this is if a senator goes up and on the record provides insights, or there's an expert witness from those different things. Those are all put into that. All right, so that really concludes the discussion of the legislative sources. Go back over these different legislative sources. Go back over these items. Look at the structure of the Internal Revenue Code, of the section. These things are very important. And just note that legislative sources like the Internal Revenue Code are very, very important when doing tax research.